Today, we're doing a complete breakdown of ASC 505. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before ASC 505, categorizing and reporting equity transactions was a nightmare for companies. Imagine trying to account for shares issued, treasury stock, and dividends without a clear guideline. ASC 505 introduced order, ensuring consistent equity reporting. After understanding this section, you'll grasp how companies maintain transparency and consistency in equity-related disclosures. ASC 505 brought clarity to equity transactions by providing explicit guidance on accounting for stock issuance, buybacks, and dividends. Before its introduction, companies faced diverse interpretations, causing inconsistencies in financial statements. By standardizing these transactions, ASC 505 ensures transparency and comparability, which is crucial for investors analyzing financial health. Grasping ASC 505 helps demystify equity-related disclosures, fostering informed decision-making. ASC 505 is mandatory for all entities involved in equity transactions in the U.S., effective from fiscal years after December 15, 2008. Its most crucial requirement is distinguishing equity from liability transactions, a classification that impacts financial ratios, investment decisions, and credit assessments. Understanding this differentiation is vital for maintaining accurate financial reporting and avoiding misrepresentation of a company's financial position. Mastering ASC 505 is key for anyone involved in financial reporting. The equity transactions model, under ASC 505, offers a structured approach to handling diverse equity events, such as stock issuance and dividend distributions. It ensures these transactions are consistently and reliably reported, enhancing the credibility of financial statements. For interview preparation, knowing this model demonstrates your ability to navigate complex equity accounting scenarios, showcasing your proficiency and readiness to manage challenging financial reporting tasks. Mastering this model is a crucial skill for finance professionals. Scope sets the boundaries for what ASC 505 governs. A common pitfall? Mistaking debt instruments as covered by this standard. It's crucial to differentiate, as this oversight can trip you up in interviews. Avoid classic tracks by knowing that non-equity financing arrangements fall outside its purview. ASC 505 applies to specific equity transactions, such as shareholder dealings, which shape financial reporting. Share-based payments, like stock options, ensure that employee compensation is accurately reflected. Issuance of preferred stock, with its dividend implications, is also included. Understanding these inclusions helps in distinguishing relevant accounting treatments from those outside the standard scope. ASC 505 explicitly excludes debt instruments, a critical distinction since these involve liabilities, not equity. Non-equity financing arrangements also fall outside, focusing on different financial structures. Convertible debt, combining debt and equity traits, is another exclusion. Treasury stock transactions don't fit within the standard, although they relate to equity, highlighting essential boundary lines for precise financial reporting. Equity serves as the residual interest in a company's assets after liabilities. It's a key indicator of financial health, reflecting ownership value. For instance, a firm with $100 million in assets and $70 million in liabilities possesses $30 million in equity, showcasing the net worth. Understanding these figures helps evaluate business performance and make informed investment decisions, emphasizing equity's importance in financial analysis. Share-based payments are transactions where a company exchanges equity instruments for services. These align employee incentives with shareholder interests by offering instruments like stock options. For example, if a firm grants 1,000 stock options with a fair value of $10 each, it must recognize the fair value at the grant date. Proper accounting of these transactions is vital for reflecting accurate compensation costs in financial statements. Edge cases challenge your understanding of ASC 505's boundaries. Consider if convertible preferred stock falls within its scope, or whether a cash-settled bonus plan is covered. Partnership distributions often raise questions, as they typically aren't within ASC 505. Issuing warrants for debt securities is another complex scenario, testing your grasp of equity versus liability accounting. These nuanced distinctions can trip you up in both exams and real-world applications. Imagine a business issuing shares to acquire a service. ASC 505's equity transactions model ensures such transactions reflect accurately in financial statements, avoiding hidden complexities. This section decodes the model's steps, crucial for transparency in financial reporting. The equity transactions model provides a structured approach for handling equity-based deals in accounting. We'll explore this through Meridian Corporation, which signed a $10 million SaaS contract with Acme Incorporated, including a $2 million software license. Each step ensures precise reflection of the transaction, improving clarity for stakeholders. Identifying the type of equity transaction is crucial. Meridian Corporation's $10 million SaaS deal involves a $2 million software license, classified as an equity transaction with Acme Incorporated. Many get this wrong by misclassifying, affecting balance sheet accuracy. Correctly identifying ensures compliance with ASC 505, setting a solid foundation for fair value determination. Determining fair value is pivotal for accuracy. Meridian Corporation must value its $2 million software license from Step 1 using market comparables. Ignoring market data can skew valuations. ASC 505 emphasizes using observable market inputs, ensuring valuations reflect true market conditions, readying us for accurate financial recognition. Recording transactions at fair value is essential. Meridian Corporation must recognize its $2 million software license from Step 2 in its financials at the market-determined value. Delayed recognition muddles transparency. ASC 505 stresses prompt recording, ensuring stakeholders see an accurate financial picture, setting the stage for disclosure. Disclosing equity transaction details is key for comprehension. Meridian Corporation must detail its $2 million license from Step 3, including valuation methods and impacts in the notes. Incomplete disclosures can misguide stakeholders. ASC 505 mandates thorough notes, ensuring all parties understand the transaction's financial implications, completing the equity transaction cycle. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 505 establishes how companies measure equity-based transactions and the critical disclosures that follow. Understanding these choices helps finance teams present accurate and compliant financial statements. Initial recognition under ASC 505 requires measuring equity transactions at fair value on the grant date. For example, when issuing stock for services, the value is determined by the market price. If fair value isn't determinable, there's no recognition until conditions allow. This ensures financial statements reflect true economic events. After initial recognition, equity instruments under ASC 505 are generally not remeasured. However, if significant market conditions change, remeasurement might be necessary, especially for cash-settled transactions. Consider a scenario where initial valuation is at $10 per share. Adverse market shifts mandate reassessment to ensure accuracy. On the balance sheet, equity instruments are shown as additional paid-in capital or common stock. For instance, issuing $100,000 in shares for services appears in equity. The income statement may show stock compensation expenses. Detailed notes explain arrangement specifics, ensuring transparency for stakeholders about equity's impact. ASC 505 mandates disclosing the types and terms of equity instruments, vital for transparency. Fair value assumptions must be clearly explained to aid investor analysis. Disclosing reconciliations from opening to closing balances shows transaction impacts, while details of modifications provide insights into a company's financial strategies. Imagine a CFO issuing $250,000 in shares for consulting services, recorded in equity. The market price at grant date determined fair value, eliminating the need for later remeasurement. Disclosures and notes detail share terms and consulting contract specifics. This strategy preserves cash flow, while leveraging equity for business needs. Meridian Corporation, a global manufacturing company, issues 1 million shares as part of a $5 million equity financing round. Examine each accounting event to see how this transaction unfolds in accordance with ASC 505. Meridian Corporation records the issuance of new shares per raise capital. ASC 505 requires recognizing the par value in common stock and the excess over par in additional paid-in capital. This boosts Meridian's equity by $5 million, reflecting the cash inflow and increased shareholder investment. Meridian Corporation declares a $500,000 dividend to its shareholders. ASC 505 requires reducing retained earnings, as dividends are distributions of earnings. A liability is recognized in dividends payable. This entry reflects Meridian's commitment to distribute profits, impacting equity and current liabilities. Meridian Corporation settles its dividend obligation by paying $500,000 to shareholders. In line with ASC 505, the dividends payable liability is cleared with a corresponding reduction in cash. This transaction completes the dividend cycle, decreasing both current liabilities and cash reserves. Meridian Corporation decides to repurchase 100,000 shares at $10 each, aligning with ASC 505's guidance on treasury stock. The treasury stock account is debited to reflect shares held by the company. Cash decreases by $1 million, reducing both assets and equity. Meridian Corporation reissues 50,000 treasury shares at $12 each. ASC 505 dictates the reissuance is recorded at cost, with the excess credited to additional paid-in capital. This transaction enhances cash by $600,000 and equity by $100,000, reflecting the gain from the stock reissuance. Meridian Corporation recognizes $200,000 in stock-based compensation, impacting compensation expense and additional paid-in capital. According to ASC 505, this non-cash expense reflects employee benefits paid with equity, reducing net income while increasing equity, aligning compensation with performance incentives. Meridian Corporation assesses an impairment loss of $50,000 on its treasury stock. ASC 505 requires this adjustment, impacting retained earnings and reducing treasury stock's carrying value. This reflects diminished asset value affecting equity by reducing retained earnings, signaling a potential strategic shift in stock management. Meridian Corporation completes its equity management cycle by de-recognizing remaining treasury stock, aligning with ASC 505's requirements. Retained earnings absorbs the $450,000, eliminating treasury stock from the books. This strategic move closes out prior repurchases, streamlining equity accounts, and potentially setting up for future capital activities. Every Big Four and investment bank interview on ASC 505 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 505 covers equity-related issues, including stock issuance and dividends. It's designed to ensure accurate equity reporting. An example is recording stock options correctly to reflect shareholder equity. A common mistake is confusing equity with liabilities, leading to inaccurate balance sheets. Remember, ASC 505 focuses on equity instruments, not debt. Understanding this can prevent costly reporting errors. ASC 505 exists to standardize how companies report equity transactions, ensuring transparency and consistency. For example, it dictates how stock options are valued and reported. A common trap is overlooking disclosure requirements, which can mislead stakeholders. Remember, ASC 505 protects investors by ensuring they get a clear view of a company's equity position, vital for informed decision-making. When recording stock issuance, ASC 505 requires the company to recognize the issuance at fair value on the issuance date. For instance, issuing 1,000 shares at $10 means recording a $10,000 increase in equity. The trap is underestimating fair value, which can distort financial statements. Always ensure the issuance reflects the current market conditions for accuracy. ASC 505 requires dividends to be recorded as a reduction in retained earnings. For example, declaring a $5,000 dividend reduces retained earnings by that amount. Misunderstanding this can lead to incorrect equity reporting. Always remember, dividends affect the equity section, not liabilities, ensuring that the financial statements accurately reflect the company's distribution to shareholders. ASC 505 and Indian Accounting Standard differ mainly in measurement and disclosure. ASC focuses on US-specific rules, whereas Indian Accounting Standard aligns more with international financial reporting standards. A notable difference is in the treatment of stock options, where Indian Accounting Standard might use a different valuation model. Misunderstanding these can cause compliance issues. Always compare standards carefully to ensure accurate reporting. ASC 505 and International Financial Reporting Standards differ in disclosure requirements and measurement methods. ASC often requires more detailed disclosures for stock-based compensation. International Financial Reporting Standards may use a different approach for measuring equity instruments. A common mistake is applying U.S. generally accepted accounting principles under International Financial Reporting Standards, leading to compliance issues. Always adapt your reporting approach based on the applicable framework. To calculate stock compensation expense, ASC 505 requires you to determine the fair value at grant date and expense it over the vesting period. For instance, if options worth $20,000 vest over 4 years, expense $5,000 annually. The pitfall is ignoring changes in vesting conditions, which can misrepresent expenses. Always align calculations with vesting terms for accuracy. For a complex equity transaction, say a convertible preferred stock issuance, ASC 505 requires splitting the instrument into equity and liability components. Calculate each component's fair value separately. A common error is failing to update valuations at conversion, skewing financial statements. Always ensure each element is correctly identified and recorded per ASC 505 guidelines. A frequent mistake is excluding certain stock-based compensation arrangements, assuming they fall outside ASC 505. It's crucial to include all equity-related transactions, such as stock grants or options. Overlooking these can lead to incomplete financial statements. Always verify the inclusion of all equity activities to ensure comprehensive reporting under ASC 505. ASC 505 mandates comprehensive disclosures for equity instruments, including detailed descriptions of the terms and conditions, valuation methodology, and any changes in equity. Failure to disclose accurate information can mislead investors. It's essential to provide a transparent view of all equity-related activities to comply with ASC 505, ensuring stakeholders are well informed. ASC 505 is all about how companies manage their equity transactions. It governs the issuance and repurchase of equity instruments like stocks and options, even for non-employee services. It's essential for understanding how equity impacts financial statements, from defining equity as a residual interest to handling capital transactions. If you're looking at a company's equity structure, keep these basics in mind to navigate its complexities. The core of ASC 505 lies in its equity transactions model. It ensures that equity transactions like stock issuance or buybacks are measured at fair value. Issuance costs are offset against proceeds, while contributed capital is adjusted for premiums or discounts. Understanding how convertible instruments and repurchase agreements fit into this model is crucial for precise financial reporting. When preparing for an interview on ASC 505, remember the common traps like misclassifying equity instruments as liabilities. Understand how ASC 505 varies from other standards, especially in equity issuance. Disclosure of all equity instruments is crucial, and complex instruments like convertibles require careful handling. Equity impacts on earnings per share are significant, and proper classification prevents costly errors. Master these essentials to excel in any discussion on this topic. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.